Have you ever wondered what makes Warren Buffett, one of the most successful investors in the world, stand out from the crowd? The answer lies not in complex algorithms or insider information, but in his simple, timeless wisdom on investing. Warren Buffett, the legendary Oracle of Omaha, has carved out a niche for himself in the world of investing, a world often marked by volatility and unpredictability. With his uncanny knack for making sound investment decisions, he has amassed a fortune, turning Berkshire Hathaway into a global powerhouse. His success is not a product of luck or coincidence. Rather, it's the result of adhering strictly to a set of principles, a set of 6 golden rules that guide each and every one of his investment decisions. These rules have not only guided him, but also inspired countless investors across the globe. So, what are these 6 golden rules that guide Buffett's investment decisions? Let's delve into them one by one. Rule number 1. Warren Buffett sees investing not as a game, but as a means of purchasing value. Now that's a powerful statement, isn't it? It's easy to get caught in the whirlwind of stock prices, market bets, and the thrill of quick profits. But this isn't the approach of a seasoned investor like Buffett. He understands that investing is about recognizing the intrinsic value of a company. It's about identifying businesses that demonstrate strong fundamentals and a promising long-term future. It's not about trying to make a quick buck, but about seeing the bigger picture. It's about buying a piece of a company, not just a ticker symbol. You see, when you're playing a game, you're hoping for quick wins, quick gratification. But investing is not a game of chance. It's a game of patience and understanding. It's about buying into a business and becoming a part owner of it. It's about investing in the company's future and sharing in its success over the years. This perspective changes the entire approach to investing. Instead of watching stock prices rise and fall with bated breath, you're looking at the company's performance, its management, its competitive advantage, and its potential for growth. You're investing in a story that unfolds over time, not a fleeting moment of market euphoria. So, remember, investing is not about quick wins, it's about long-term value. This is the wisdom we can all learn from Warren Buffett's first rule of investing. Moving on to rule number 2. Never invest in a business you cannot understand. This is a mantra that stands the test of time. In the world of investing, it's easy to be drawn to the glitz and glamour of the next big thing. But if you don't comprehend the business model, the industry, and the potential challenges a company could face, you're essentially navigating the financial seas blindfolded. Imagine this: you're a chef, and you're asked to prepare a dish you've never heard of. You don't know the ingredients, the cooking method, or even what it's supposed to taste like. Would you feel confident serving that to your customers? Probably not. The same principle applies to investing. If you don't understand a business, how can you confidently put your hard-earned money into it? Understanding a business goes beyond knowing what they sell or the service they provide. It's about knowing their strategy, their competition, their financial health, and the industry trends that could impact their success. It's about delving into their annual reports, their financial statements, and their press releases. It's about being informed. When you know a business inside and out, you're better equipped to make sound investment decisions. You can anticipate challenges, spot opportunities, and ultimately safeguard your investment. So before you dive headfirst into an investment, take the time to do your homework. Understand the business, the industry, and the potential risks involved. Because as Warren Buffett himself would say, risk comes from not knowing what you're doing. In other words, knowledge is power when it comes to investing. Buffett's third rule of investing is to always invest for the long term. It's a piece of advice that's as timeless as it is profound. Why? Because it's all about the magic of compound interest. Compound interest is when the interest you earn on your investment starts earning interest itself. It's like a snowball rolling down a hill, gathering more snow and gaining momentum as it goes. The longer you leave your money to grow, the more impressive the results. But long-term investing isn't just about watching your money grow, it's also about weathering the storms. The stock market is a tempestuous beast. It can soar to dizzying heights one day, only to plummet the next. But if you're in it for the long haul, these short-term fluctuations become less scary. They're just bumps in the road on your journey to financial growth. Investing for the long term also means having the patience to stick with your investments, even when things aren't going as planned. It's about resisting the urge to jump ship at the first sign of trouble. Instead, it's holding on, trusting in the strength of your investment and its potential for future growth. This is the essence of Buffett's third rule. It's not about quick wins or instant gratification. It's about playing the long game and reaping the rewards that come with patience, perseverance, and time. As Buffett himself says, our favorite holding period is forever. Rule number 4, limit what you borrow. This is a crucial principle that Warren Buffett has always emphasized. Borrowing money to invest might seem like a smart move, especially when the interest rates are low. It might even appear to be an easy way to amplify your returns. However, it's worth noting that while borrowed money can indeed magnify your profits, it can also amplify your losses. Imagine a situation where you borrow money to invest in a venture that, unfortunately, doesn't pan out as planned. Not only have you lost your initial investment, but you also have a debt to repay. This can lead to a financial crisis, making it difficult for you to recover and re-strategize. This is why Buffett advises against excessive borrowing. Furthermore, borrowing to invest creates an additional layer of risk. Market conditions can change rapidly, and what seems like a surefire investment today can turn into a losing proposition tomorrow. If you're investing with borrowed money, these swings can be devastating. Buffett's philosophy is simple and effective. Spend less than you earn, invest the rest, and never borrow to invest. This approach not only limits your financial risk but also ensures you're building wealth over time, rather than gambling on quick, uncertain returns. In Buffett's words, do not save what is left after spending. Instead, spend what is left after saving. This encapsulates the essence of Rule 4, reminding us to prioritize saving and investing over spending, and to avoid the pitfalls of borrowing. Rule number 5 is perhaps the most famous. Be fearful when others are greedy, and greedy when others are fearful. This rule is all about going against the grain and not being swayed by the crowd. You see, investor sentiment can often drive market trends. When people are greedy, they drive prices up. When they are fearful, they drive prices down. But these trends don't always reflect the true value of an investment. In fact, they often don't. That's because emotions can cloud judgment. Greed can make people overvalue investments, while fear can make them undervalue them. This creates opportunities for savvy investors who are able to keep their emotions in check. So when others are greedy, when they're driving prices up, that's when you should be fearful. That's when you should be wary of overvalued investments. Conversely, when others are fearful, when they're driving prices down, that's when you should be greedy. That's when you should be looking for undervalued investments. But remember, this isn't about blindly doing the opposite of what everyone else is doing. It's about making rational decisions based on a clear understanding of an investment's true value, not on the current mood of the market. And that brings us to the heart of rule number 5. It's all about keeping a cool head and making rational decisions, even when everyone around you is losing theirs. Finally, rule number 6. Always have a margin of safety. The concept of a margin of safety is a cornerstone of prudent investing. Simply put, this principle advises us to only invest in a business when its market price is significantly below its intrinsic value. This cushion between price and value provides a safeguard against unforeseen events, risks, or miscalculations. It's like a safety net, ready to catch you if the high-wire act of investing gets a little shaky. Warren Buffett, a stalwart advocate of this principle, learned it from his mentor, Benjamin Graham. Graham famously compared investing to shopping. You wouldn't buy $1's worth of goods for 100 pennies, would you? Of course not. You'd want to get it for 80 or 90 pennies. That's your margin of safety. Now you might be wondering, how do I calculate the intrinsic value of a company? Well, it's not an exact science, and different investors have different methods. Some look at cash flow, others at earnings or book value. But the goal is always the same: to estimate what a business is truly worth, separate from its current market price. Having a margin of safety doesn't guarantee that you won't lose money. No strategy can promise that. However, it does tilt the odds in your favor, providing a buffer against the unpredictable nature of the market. As Buffett wisely says, rule number 1, never lose money. Rule number 2, never forget rule number 1. So there you have it, Warren Buffett's 6 rules of investing. Let's quickly recap. Rule 1 is a stark reminder that investing is not a game, but a serious commitment that requires careful thought and decision-making. Rule 2 advises us to stick to what we know, emphasizing the importance of understanding the businesses we invest in. Next, Rule 3 encourages us to invest for the long term. It's about patience and the ability to weather the ups and downs of the market. Rule 4 advises us to limit borrowing, reminding us that debt can be a dangerous tool in investing. Rule 5, a classic Buffett saying, urges us to be fearful when others are greedy and greedy when others are fearful. It's about going against the crowd and seizing opportunities when others are too scared. Lastly, Rule 6 emphasizes the need for a margin of safety in our investments to protect us from unforeseen circumstances. Remember, investing is a marathon, not a sprint. So take a page from Buffett's book and invest wisely.